Okay, so I think this was the slide where we ended last week. We are now going into in-depth discussion about the return and risk because the capital structure is a very important component of corporate finance. But I would say that capital structure is not something which is exogenous. It doesn't come from, it's not externally imposed upon you. A firm has to consider several key determinants, the key pillars, before they make a decision about what is the optimum capital structure for a firm in a given situation. And the risk and return are the two major, the core element of any discussion about capital structure. That's why I'm going more in depth about risk and return. I want to take one more example because last week when we met, we had some discussion about some element of probability that, while you make some estimates, we cannot rule out, even though finance looks very objective, very quantitative, very number oriented, and we know that the numbers are the numbers. They are what can be more exact than the numbers. But their interpretation, their context can change depending upon the attitude, behavior, the mindset of those people who are doing those calculations. Okay, so in this example, we will bring the behavioral side once again in the discussion. It's a simple example, not very complicated. Let's assume that there are three possible scenarios for an economy. Now remember, this is very important. Even the last week when we had the example, on the previous slides, I tried to connect the economy with the firm level. Look, we are studying firm level capital structure. And we have had two examples so far where we talk about the economy. So strong are the macroeconomic fundamentals are on the decision making at the firm level. It's like a trickle-down effect. So if something, if economy sneezes, then the firm, catch cold. So it's so much they are intertwined with one another. Okay, so if you want to be a good student of finance, then you must have pretty decent background of economics, particularly macroeconomic fundamentals. Suppose that there are three possible scenarios for an economy. There can be recession, there can be normal growth period, and there can be a boom period. And if there is a recession period, then the stock fund will go down at minus 11%. So if the economy is not growing, is growing but not, it's a recession. Then the stock fund will go down at 11%. And if there's a normal period, then let's assume that the market, the stock fund, your portfolio would go up by 13%. And if you have boom period, then you have a bonanza, then you have a jackpot, then your stock fund is expected to increase by 27%. On the other hand, if you have a bond fund, sorry, this should be example 5, should be on the previous slide. Anyways, but this is a continuation of the example. Now, suppose that there is a recession. Then if some investor has a bond fund, it will increase 16% in the recession. And if there is a normal period, normal economic period, then the bond fund will go up by 6%. And if the market is really flourishing, then the bond fund would be going negative, minus 4%. Now, even though these numbers are slightly exaggerated, but the sign is not exaggerated. Okay? Because if there is the market is booming, at that time, the stock fund will go up like anything. But look at that, when the market is booming, the bond fund is really struggling and going down, and it's very normal. It's very normal because who would invest in the bond? I mean, look at the market is going up. The macroeconomic fundamentals are so promising. The inflation is in control. The interest rates are stable. The exchange rates, they are stable, and they are working in a favorable terms for the economy. You have strong macroeconomic fund. The domestic market, the domestic demand is going up. The consumer goods are more demanded. There's more investment. The saving rate is going up. The level of unemployment is going down. The people are getting more and more jobs. Everything is very rosy. Okay? So if you are an investor, why would you invest in the bond fund? Okay? Maybe very tiny fraction of the very extreme risk haters, maybe they would go in the bond fund, even when the bulk of the market is going up. Like you are almost having mid-90s in the US, early 90s and mid-90s, when the stock markets were, they were having astronomical increase, that IT boom. Well, you can call it IT bubble, but there was a time period when it was laughable for an investor to invest in the bond fund. Okay, so on the other hand, if there is a recession, then the stock fund is going down. Whereas in the recession time, as a last resort of investment, the bond fund come for the rescue, because that is giving you at least something, because people are losing immense amount of money during recession if they invest in the stock fund. But when they are investing in the bond fund, they are getting some return, at least the risk-free rate, the treasury bond rate, which the treasury is offering. And if it is a corporate bond, which is comparatively lesser riskier than the stock, even that can give you some positive return at that time. So therefore, even as I said, that these numbers are very extreme, but the signs are very, reasonable. So in that case, what we do, and let's say that we have this kind of situation, that there is a probability of recession, normal, and the boom time, 30%, 40%, and 30%. So it's, once again, I made a very bell-shaped, normally distributed probability. So most likely, 40% chances that the economy would be normal. And then I put these numbers: stock fund, minus 11%, normal time, 13%, boom time, 27%. And then I have the stock fund and the bond fund here. So I take the same numbers, not same numbers, but 16, 6, and minus 4, which are here. 16, 6, and minus 4. I take it here. Okay. And then what I do, I know that the probability is 1, and then we can use some basic statistics. I would say the arithmetic average, what we do. If you are interested to know, and let's make one more assumption, that you are an investor who invests 60% in the stock and 40% in the bond. So you are kind of risk neutral type of investor. You don't want to go too much into the extreme amount of stocks. Neither you are extremely risk averse, okay? Because after all, you're investing 60% of your stocks, wealth, in the stocks. And then we can calculate what is the expected return during recession time. Well, it's very simple. You invest 60% of your wealth in the stock fund, which gives you minus 11%, and then you invest 40% of your wealth in the bond fund, which gives you 16%. And when you make these calculations, you find out that there is minus 20% overall portfolio return. Okay, now that's quite simple. I don't think anybody would find this complicated. So perhaps in the next few minutes, I want to give you this task because you can have these slides. I want you to calculate the expected return for this investment, 60-40, in 60 in stocks, 40 in bond. I want you to calculate the expected return for the normal period and for the boom period. And I also want you to calculate an overall expected return, regardless of recession, normal, and boom period. The recession I have done already, which is solved here. And then your next job would be, you need to do three things rather, in this simple example. Calculate the expected return for the normal period and for the boom period and for the overall period. Okay, so good luck to you. And this is the statement if you want to see the question, but you have the slides anyways. Great. You all have done very good calculations. Normal, you did. Boom period, you did. Now you guys do one last thing about this task, that you calculate the overall return for this investor who is investing 60% his stakes in the stock and the 40% in the bond. And what you need to do now is that find out the overall. If you want to make it, okay, there is a recession, there is normal, there is a boom period. What is the overall return? Like some kind of average expected return. You guys did for the recession, you assume that then it's a recession. Normal in normal, boom in boom. So you use in a way, you guys use the conditional probability that calculate the expected portfolio return if it is normal period. But now you guys need to consider all the situations together. And I gave you, how many minutes I should give you? 3 minutes to solve this puzzle. Find out the overall return of the portfolio. So in this case, so now we bring the probability element, because when you want to find the overall return, then you need to consider all three situations, and all three situations have the probability. So when you multiply the probability with the respective returns, you have another column, and you find out that regardless of the economic situation, the most likely rate of return on stock fund is 10%. And similarly, when you multiply probability with the respective rate of return on of the bond fund, you find another column. And this, when you add it up, it shows you 6% expected return on the bond fund. 6% on the bond fund, 10% on the stock fund. And now we keep the 60-40 ratio same, we don't change it. And when you multiply 60% on 10, 0.6 on 10% and 0.4 on 6%, you get 6% from here and 2.4% from here. And when you sum it up, it becomes 8.4%. So overall, if you want to make a forecast about this, if you are a hedge fund manager and you are trying to give an answer to your client who's very much worried that, hey, what would be my expected return? Then based on your forecast estimates, which you make by yourself or you take from some credible resources, you can calculate the rate of return on two different assets, financial assets, in the light of macroeconomic conditions, expectations. Okay, so this, even though this is a very simple example, but it tells a very important message that how well the fund managers, not only fund managers, but even the corporate finance managers, how much they value the macroeconomic information. So basically your task one is done, so you don't have to worry about it, because my plan was that I would give you this task to make some calculations by yourself from home, but we have done it here, which is a good thing. And this is what I did in those calculations. If I put in the notational sense, if I put some notation, then this is how the expected rate of portfolio would look like. You sum up the weight of each condition, like weight in each economic situation, and then the expected rate of return in each situation. And that would give you the portfolio return in percentage or in proportion. And here sigma, alpha, sorry, this alpha I is the weight in each condition you put. Now any discussion about this portfolio would be incomplete if we don't bring in the discussion the not only return but also risk. This is the kind of notation for the two-stock portfolio risk. And you can see here that here the risk has been measured by variance. But of course, if you take a square root, we can make it a standard deviation also. Standard deviation is something which I prefer, as a measure of risk. If you have, so you can see here, I don't know whether you remember or not, but I remember one formula in algebra, a plus b whole square. And why I take a plus b whole square? Because there are two stocks. And if I remember the a plus b whole square, if I open the brackets, it's a square plus b square plus 2ab. AB is the covariance of both stocks together. Overlap. Okay, so the individual risk of each portfolio, individual risk of the other portfolio, multiply by, of course, by the fraction, the weight, the percentage you invest in. Look, there is a one change that when you are expected rate of your, there's no overlap between the return. But when you, there is an element of overlap between the two. Okay, maybe risk is more important. So basically, if I draw a very quick picture, I make a drawing. So if each circle is showing the riskiness, if this part is showing riskiness of stock or portfolio A, and if this portion is showing the riskiness of stock or portfolio B, and both are shown by their standard deviation, the same thing will be on the A side also. Then we have some then we have this portion, basically. This portion. This shows basically the overlap. So this is the, I can color it. I think, no, I don't know what I've done, but yeah. So this portion, the middle portion, you can say that this is kind of, oh, sorry. Yeah. So this is the portion which we can call as a overlap, and this is represented by the you can say the covariance. So therefore, if you want to be really good in certain disciplines, certain topics of finance, then I think if you want to master finance, then your information about your knowledge and skills of econometrics and statistics are highly relevant. So you should be knowing that what is covariance and these kind of things. So yeah. Okay. So, but similarly, if you have an N stock portfolio from 2 to N, then this notation become more generalized, but basically nothing changes. So if you know the notation of 2 stock portfolio, then you can very well find out the notation of N stock portfolio. The only thing is that instead of 1 and 2, you are using I and J, because there can be I combinations and there can be J combinations, and then there would be some overlap between I and J. So you make it more generalized. Otherwise, nothing can change. But this is for your theoretical understanding. When you apply this, when you make a real application of calculation, and you usually use the Excel or SPSS or any other software, so you normally don't have to memorize. So if you become a practitioner of finance, then you don't even need to know this formula, because things are so automated. But for theoretical information, you must know that the concept of mean, dispersion, variance, standard deviation is highly important, and covariance especially is very relevant when you are calculating risk and return. Okay. Yeah. And just to let you know that the covariance is basically equal to the correlation. You know, there is a symbol rho, RHO here. There is a symbol rho, Greek letter, which I and J, you know, the 2 portfolios. And this is equal to the correlation of 2 stocks or 2 portfolios or 2 assets, multiply with their respective standard deviation. This small sigma, this is also sigma, but this is not that E looking sigma. This is also sigma, Greek letter, but this is a small letter. And in statistics, we use this symbol to denote the standard deviation. Okay. And this is how you can calculate covariance between 2 stocks or 2 assets. But the word of caution, generally the critics, they are of the opinion that, hey, why are we using covariance? Because covariance has one problem. The problem with the covariance is that this is an absolute measure. So for example, covariance, for example, if you want to find the, you have one variable, marks in statistics, and the second variable is marks in economics. Then when you find the covariance, your answer will also be in marks. But the problem is that we don't want, it means that when you're using the absolute measures, then the size, you know, counts. The absolute size counts. If you ask some researchers, they would say that, you know what, it's not a good idea to have the size effect involved. Let's have a relative measure. Relative means which is free from scale. It's a fraction. It's a coefficient. So in that case, they would prefer to calculate the same thing which covariance calculate. They would prefer the correlation coefficient instead. Okay, because the beauty of the correlation coefficient is that its value minimum is -1 and the maximum is +1. So it can be 1, +1, 0, -1, and in between, it can take any value. Now, what does it mean? It means that the correlation coefficient is more standardized coefficient. Okay, it cannot have infinite value. Whichever portfolio, whichever two stocks you are comparing, the value must lie between 1 and -1. Whereas in covariance, if you are comparing two samples, yeah, right, then the comparison becomes a little bit tricky because they can have extreme variation in terms of their values. So if you ask, I'm not a statistician, I'm not an econometrician or a statistician, I'm more like a practitioner of these two disciplines. So if you ask some teacher who is more into quantitative finance or quantitative techniques, they would tell you that given the choice, we prefer, if you want to have a firm-to-firm comparison, then it's good that we have the relative or comparative measures like correlation instead of absolute measures, rather covariance or mean or median. So yeah, so this is more standardized in nature. Okay, so I try to explain with my little knowledge of statistics. Yeah, that is something which I just said, that the good news about the correlation is that it's not very, it's not too much impacted by the extreme numbers, because the range would always be between -1 to +1. And actually, it can work as a good self-check. If you ever calculate correlation and the value is more than 1, then you don't even show your teacher it's wrong, because it can never be. It can never be more than 1, either side. And this is something, the efficient frontier, which we also discussed, that how the correlation make an impact, how the risk thing between two stocks, how the correlation can have an impact on the risk of the two stocks or two portfolios. Now, in this picture, it's a very simple picture. It's not, I think you can find in any textbook of finance, just any textbook of finance. Whether it's a wealth management, it's a behavioral finance, it's corporate finance, it's a treasury finance, whatever it is, you cannot miss this picture. On the horizontal axis, if we calculate the riskiness as shown by the standard deviation, and on the vertical axis, if we calculate the expected return, as you guys did for normal and the boom period, then we can have different relationships depending upon the correlation between the two assets, like we did in case of stock fund and the bond fund. The usual notion is that higher the coefficient of correlation, and here we have the highest correlation, for the given amount of risk, the return is the least. Because the correlation high, it means that you are buying two stocks with almost, like clone to each other, basically. So for example, if you're buying, well, I don't take my words in the absolute sense, but for example, if you are taking two stocks and they are Coke and Pepsi, I wonder what is the difference between them. What is the difference? Maybe, of course, the difference is there, but all the macroeconomic factors, all the seasonal factors, all other major factors, especially the market factors, which, or even their unsystematic risk within the company. I know that, when this lady, former CEO, in the when she was going to change her job, she was going to leave Pepsi, it was a big kind of raw and with a lot of fluctuation. There were a lot of internal problems in Pepsi at that time. So those are the different things. But mostly the major common factors which affect Coke also affect Pepsi. Or I can take an example of, for example, BP and Shell, Microsoft and Apple. So these are very closely correlated stocks. So here you can expect that for the same amount of risk, the return can be the least. But as the correlation goes down, for example, the correlation declined from +1 to 0.3. I just take an example. Then what happened? That for the same level of risk, the return increases. And similarly, if you are having two stocks with exactly opposite nature, and their correlation is -1, means if one increased by 20%, the other falls by 20%. So in that case, and this is exactly we discussed while having the word effective diversification. That is every diversification is a diversification in real terms. And the answer was that no, we have to be very, and how you find the effectiveness of diversification, that I think the correlation coefficient can be a good measure. And you can see here that when the correlation between the two stocks is -1, then for the same amount of risk, the return is the highest. Okay, I can say that lower the correlation, higher is the return for the given risk, or lower is the risk for the given return. And higher is the correlation between two stocks or two assets. Lower is the return for the given risk, or higher would be the risk for the given return. Okay, so therefore these things we need to keep in mind, these conceptual things. I give you a short break for 10 minutes, and when you come back, I would show you a spreadsheet exactly indicating this phenomenon of efficient frontier. Okay, so let's take a short break, and we will be seeing each other in it's 5 o'clock, so let's resume at, let's say, 13 past 5. So you have about 12 minutes break, and then we catch up. See you soon. So before we went to the break, we were discussing about the efficient frontier, that how the efficient frontier can change thanks to the coefficient of correlation. And we had a discussion about it, that if the stocks or the portfolios are highly correlated, then for the same amount of, or the same percentage of risk, the return is lower, or for the same percentage of return, the risk is higher. On the other hand, if we have low correlation coefficient between the two financial assets, then for the given level of risk, the return is higher. And for the given level of return, the risk is lower. So it works both ways. You can see here that yeah, just a sec. So here I was calculating 16 to 11. Yeah, okay. So what change I made in this? Yeah, okay. Yeah, all good. Now, in this example, We have two stocks, X and Y. And if you are investing all your wealth in X, you would be getting 10% of annual return, but at the same time, you have to face 20% of the risk as measured by the standard deviation coefficient. And then the second option is that you can take 15% return, but then the risk is 30%. So it's like a very simple adage that no pains, no gain. So if you go for more return, then be prepared to get the exposure to the higher level of risk as well. If you are extremely a risk lover in both situations, then you only pick up one stock. But the fact of the matter is that we always make a portfolio. Well, not always, but usually it's a good idea to make a portfolio to minimize your risk exposure. And here I take A, B, C, D, and E. These are your, alpha. Remember in the generalized notation, I was using the phrase alpha I and alpha J, which means the proportion of investment in stock X and proportion of investment in stock J in Y, X and Y. So you can see that you can either pick up a combination. When you pick up a combination, it means you are investing. Actually, I should make it to numbers to 2 decimal places. Yeah, this looks nice actually. So you have a choice. When you pick up a combination, you invest 20% in X and 80% in Y. And you can see here that when you have the return, if you want to calculate the return of a portfolio, you are multiplying the return of X with the B4, which is a proportion on X stock, and then you have the 15% is the return on Y, and you are C4 80%, and you're investing 80% in Y, and this gives you 14% of expected return. And at the same time, you can see the portfolio risk as well. And I deliberately use the full formula, the main, the theoretical formula here, which is, I think I compared with A plus B whole square, that there is a risk coming from one stock, the risk coming from the second stock, and then there's a covariance, the joint risk. So this portion basically is when I compare, so that is the covariance part. And you can see that as we move down, you see that the share of X increase in the portfolio and the share of Y decrease in the portfolio. Because share of Y is decreasing and the share of X is increasing, then the expected return obviously will go down, because we know from the numbers that Y gives you higher return than X. So if any portfolio have more Y and less X, which is like this, you have the more return, but then you have the more risk also. But when you have the other extreme, where you have very less, 80% you have in stock X, and 20% you have in stock Y. So the stock Y is having less percentage in the portfolio, then the return is low, but at the same time, risk is also less. But here, if you notice, I assume that the correlation coefficient is 1. Okay, so I assume here is that the correlation, the covariance, the correlation coefficient, not covariance, but the correlation between them is 1. But now you see what I do. Now I make a tweak, and the tweak is that I go to the other extreme, which basically shows that the correlation between the two stocks is -1. And guess what happens? When I put it -1, look at the standard deviation. The formula changes, but there comes J column, which is symbolizing the -1 thing. Okay, so nothing changes. The return I'm not playing with, I'm only making a tweak in the standard deviation. Nothing changes, all remain same. The only thing changes here is that instead of J column, here I bring D, which is the one correlation, highest correlation. You can see here, D10 or whatever here. But when I go here, when I go here, then I bring J column where the correlation is the least. And you can see that for the same return here, the risk is high. Just compare this and this. Just compare this and this. For the same return, the risk is higher when the correlation is the highest. And for the same return, the risk is the lowest when the correlation is the lowest. And in between, there can be different combinations. So here I take the correlation as 0.5. Here I take correlation as 0, but I just take two extreme points. And at the two extreme points, the return and the risk, especially the risk, shows that the same statement which I gave you before, that higher the correlation, and this, by the way, applies to all the combinations. So whether the combination A or combination B, for the same return, risk is the highest. For the same return, risk is the lowest. And this goes to other combinations also. There can be minor exception, but more or less, this proves the point that if the correlation coefficient is higher, then for the same return, the risk can go up. Okay, so therefore the idea that when you make a decision to invest, you need to take into account the riskiness, and correlation is a measure of riskiness. And when I put them up all here, all these numbers, then this is how the picture looks like. And this picture resembles, if you see this different colored line, of course, they basically, if you see their angle, they all are trying to converge at one point. So if I quickly draw, then they would look like this, basically. So if I draw a picture here, okay, I don't need this. This looks very strange. Okay, we get rid of this. What are we going to say here? So if I draw a line here, and if I draw a line here, and if I put return here, red, and if I have risk here, then these, how do I draw these curves actually? So I'm not sure how it to look like. Maybe like this. Yeah, it will be looking like this. So let me draw it again. Yeah. So then this would look like this, like this, like this. It means that if the correlation is the highest, then for the same risk, return is the lowest. So here, let's say R is equal to +1, which is the highest. But if you go to the extreme other end, which is -1, then for the same risk, return will go up. So this is how the efficient frontier changes, basically. Efficient frontier is the ideal frontier where all the combinations of the stocks or the assets which you choose are the optimum one. So this is how it looks like. So in Excel also, I try to bring these points together, even though they don't exactly match, but they basically, we can assume that they all start from, 1 point. So this is how the risk and return look like. And this look like because of this thing, correlation coefficient. When they move your efficient frontiers. And then, the beta we consider as a measure of systematic risk. And beta is also a relative measure, and this brings into account covariance and variance especially when you want to see the impact of systematic risk, that how the market is making the impact on the riskiness of an individual stock. Beta is basically a measure of slope. So for example, let me draw a picture because then things will be better. If I have a new share and a whiteboard, and if I want to have a new whiteboard, then we assume that if you know this mathematical function, that y is a function of x, so y is a dependent variable and x is the independent variable. So we can say that BP return, for example, is a function of FTSE 100 index. It won't be other way around. It's not that the index depends upon, unless the company is so big that it can totally shatter the entire market. Then if you draw it, then this is y. Okay. And this is x, basically. And if I want to draw another line, this would be how the slope look like. So for instance, if you want to change this, if you want to find the slope, then the slope would be basically like if I can have, for instance, this and this, like this, yeah. Now, so this change in y and here if I take the text box, x, slope is showing the change, basically. So the beta is measuring the change. And if I have one more line, here, you can see that for a same amount of change in the x, there'll be more change in the y. It means that the slope of the line is higher. And if we have a slope which is lower, almost that you can walk on it, then the slope is lower. It means that the beta would be lower. So for a given change in x, there is a very less change in the y. So here, if I increase this point here and I slightly, so you can see here that Sorry, I can't draw very accurately, but I just. So this change could be larger. Whereas here, if I draw the line almost from the same point and same extent, it's this much, very, very, very minor rise in X takes place. So the beta essentially is a measure of change in Y due to change in X, change in the individual stock or portfolio return due to the market change. And the starting point can be different or the same, but wherever it is, that is your alpha, basically. So if I use because it's a straight line, and if I use the mathematical equation, then it will be Y is equal to alpha. Can I show alpha somewhere? Or maybe I can show with the small a. And beta I can show with the small b times x. So this is how this concept of beta, which is essentially underpinning the systematic risk that the firm is exposed to, is brought in the discussion, which is based on the basic mathematics in the high school maths equation of straight line. What do we call it? Equation of the straight line, where we have slope. What is this called? The slope is fine. And intercept. Okay, intercept. Yeah. So alpha or A, because I don't know how to write alpha here, but I'm just using A. So A is the intercept, which is here. And B is the beta, is basically symbolizing the slope, which you have seen that here beta is extreme. And here beta is very low. So therefore, those stocks whose beta is very high, they can bring more risk. On the other hand, the stocks like utilities or these engineering goods, basic production, metal processing, these kind of industries are those where the market's impact upon the stock return of the company is low. So these are some kind of low beta. I remember some 3 years ago, I was looking at the beta of a utility company which which distributes electricity in America. I forgot the name of this company. The beta was 0.1 basically. So 0.1 means if all the stocks, basically because that stock was listed in New York Stock Exchange. So if all the companies, if the New York Stock Exchange increases by 1% up, that company, this utility company, its stock will go up by 0.1%. So 10th time, 1/10. On the other hand, if the New York Stock Exchange goes down by 1%, then the stock return of this utility company will go down by 0.1%. So it's just like a safe option. So that is why utility, retails, these metal processing, these are very kind of safe kind of businesses. And here you don't expect the miracles on each side too much. But on the other hand, if you have some research and development, media, R&D, research and development, or the technology companies, information technology, biotech, these are some of the example of extremely risky firms, risky sectors. So here the beta can be very high. Or one more thing, if you are producing very luxury goods, which are, again, economics come here. Those goods which, for example, housing market, if you talk about the basic apartments, If a company is manufacturing the basic, the middle income people's apartments and sell it, the beta would be comparatively low. I'm saying comparatively. But if you are selling very expensive holiday homes or these apartments in Dubai, in Bahamas, and all those exotic places, here beta would be very high, because who are the buyers? Well, they are very rich football players. They are very rich business people, the business tycoons, or politicians, or some kings or emperors, if we still have them. Well, we have many of them. They are their buyers. And if the market is going up, then suddenly there's a demand for these super exceptional, luxurious apartments. On the other hand, if the market is down, then people are just wrapping up other things, and then they think, okay, hold back. We can buy these apartments when things get better. I mean, this is not something which we can afford to wait. So in that case, the beta, the market can go down. So very extreme. And I remember one company's name is Taylor Wimpey. And the beta of Taylor Wimpey was 4.24, which means that if all the companies in the New York Stock Exchange go up by 1%, then Taylor Wimpey stock will go up by 4.24%. But if all the companies go down by 1%, Taylor Wimpey's stock return will go down by 4.24%. So the upside and the downside risk is huge. So if you see the range of riskiness would be huge. So basically, if you're a low beta company, then your upside risk and the lower side, downside, I shouldn't say low, downside risk, the range is very, very low. So these oscillations, these movements are very low. But on the other hand, if you are a company whose downside can be very low, but if all goes well, then the upside would be extremely high. So in that case, the range of riskiness can be extreme. So this is the quality of very high beta stocks. And these middle ones are the lower range, or they are the, I mean, if this is a utility company, then most likely it will be here. But if you are some kind of growth company, fast track company, IT company, or the company which is making very products for luxurious kind of, very, very exotic items, like I gave the example of this housing company, then it can be awfully, substantially risky. The upside and downside risk can be huge in that case. So this is kind of discussion, a bit of discussion about the beta, which is a measure of systematic risk. Obviously, you can find the beta from the published sources, even though I would like that you should be able to calculate beta by yourself. Okay, but anyway, that's not my priority. But maybe in one exercise, we will have discussion about beta, that how to calculate it. Okay. Let's stop sharing. Can share the slides again. You can find the Yahoo Finance is a good source of beta, and Reuters is also good. But it's very important that you should be able to learn how to calculate. In many cases, actually, the published beta is even better because it considers many factors. But when you are calculating beta by yourself, it can be, you don't include all the variables, and maybe the methodology is not as sophisticated as the methodology followed by these top analysts in the world. But at least you should be able to know to calculate it. And sometime it could be possible that you want to find the beta of certain period, last 2 months, or then maybe the published beta is not serving you're not the client, you don't pay them, so why should they do it for you? They can't provide you a tailor-made service. In that case, you must know how to find it out by yourself. This is the thing I discussed with you before. And then this is a task which perhaps you can consider to calculate it. And by the way, these tasks which I'm writing down, I'm not asking you to show me next week, but these tasks can be important component of your exam questions. Okay, so don't ignore them. These tasks can become important component of your exam questions. Because it's a exam is this year, you're not going to have the supervised exam. It's like a it's more like an assignment. Okay, so the exam/assignment. So these can be important components. So make sure that you do them so that you don't get surprised when you see them in the exam. So this year in the exam, you will see the descriptive questions, but they would be in the context of the research articles. And you will also find some calculation-based things, which basically would be your tasks. Okay, either tasks as such or slightly modified tasks. So don't get the impression that if some question is task-based, it will be as such. No, there can be some minor tweaking. So be prepared. Yeah, and one more thing. If you are doing the tasks and you have the question, your answer is accurate to the 4th decimal place, I mean to say that it's highly accurate, you will not get full marks unless you are explaining you draw the interpretation. So you are able to write the meaning of those statistics, those calculations, and also you can make some inference. Inference means you can draw how that calculation is important for the investors or for the company for the future. So to me, 3 things are very important. Calculation, of course, I don't decline I don't diminish their importance. Number 2, are you able to explain in words those calculations? That is called interpretation. I may be wrong, but this is how I understand them. And the third thing is the inference, how that number have an impact on the top managers that, hey, this is a number. Is it a good number or a bad number? Is it going to affect the company favorably or unfavorably in the future? If it is favorably, what should we do to enhance the benefits? And if this beta or any number is going unfavorably, what should we do so that we are able to solve the problem right now? We shouldn't wait. We shouldn't have a rude shock later on. So make sure 3 things. It's a time that I just randomly came into my head that I should discuss this thing. I repeat, your exam will be comprising of descriptive questions, and those descriptive questions, look, I'm saying exam/assignment because since you're doing at home, so should I even call it an exam? So basically they are the assignments. So these exam/assignments would be including descriptive questions, and those descriptive questions would be in the context of some research articles. And those exams and assignments would also include some task-based questions. Task will always be in red and marked, numbered. Okay? But when you are solving something, when you're doing some Excel calculations, make sure 3 things. Calculation. Okay? But calculation alone is not enough. After calculation, are you able to make some interpretation of those numbers? Like for example, you make 2 beta calculation and you find out that beta of Finnair, which was calculated based on the data of until January 2021 is 0.7. And the beta, which is calculated for the Finnair by the end of, let's say, February is 0.8. This basically means that the market risk which Finnair is exposed to has increased. This is the interpretation. And the inference is that this beta, now listen what I'm saying, this beta, since this is pushing the market risk, the company more towards the market risk, therefore, it is very important to find out that what are the factors which are pushing the company towards the market risk. Is there any problem with the company's corporate governance? Or is it the impact of the COVID-19 that because the airline travel is highly affected because of COVID-19, and that is why the market risk which company is exposed to is increasing. So you're making some kind of educated guess. And okay, if this is the risk, then what the company should do to have its combat mechanism that the companies stay afloat. It doesn't, how it can handle this challenge. Well, the one way of handling the challenge if the beta of Finnair goes up is that does company have the good operating cash flows? Okay, is company able to make its liquidity situation that it's able to pay back its clients in time? I would look at the cash position of Finnair straight away. And then the second thing I would look at that, what is the leverage situation of Finnair? Is it that the debt to equity ratio is going up? What is wrong? Or is it so that the company's debt is maturing in the near future? So these things can make me worried if the Finnair's beta is going up. Okay, of course you cannot find very accurately, but as long as you have a good argument, good educated guess, it will be fine. And moreover, you don't have to write pages and pages. I think these things should be very clear now, hopefully. But of course, if you have any questions about the thing which I just shared with you, yeah. By the way, this error term is the normal error term in the regression model, because there's always a difference between the actual values of the variable and the estimated values of the variable. And the error term is basically the gap between the actual and the error and the estimated values. So it comes by default when you run the regression, so don't worry about it. This example is something about the portfolio beta. I don't think this is a very technical example, so I want that you should have a look at this. But today I want you to this one task, which you may consider to do it. And this task says that, and this is task 3. We have done, this is the 3rd task, yeah? I hope I haven't missed any task in between. You take a portfolio of at least 2 years time horizon. 2 years is quite decent time if you want to make some risk return analysis of a company. Say 10th of September 2018. It doesn't really have to be, but just a kind of indication. And take at least 3 stocks in your portfolio. And then you need to calculate the decomposition of risk. So you need to find the risk of the portfolio, and you need to decompose this risk into systematic and unsystematic. And when you are doing this calculation, of course, you need the portfolio return. You can assume that you are investing 1 million, whatever, It depends. Like if you are taking stocks from the European market, then you can assume that you are investing 1 million euros. If it is American companies, you can assume that it's in the $1 million, or if it is a 1 million pound, if it is a British companies. But I would strongly recommend you that whichever 3 stocks you take, they should come from the same market. They should come from the same market. Either take 3 American stocks, or take 3 British stocks, or even take 3 Finnish stocks, or take 3 European stocks, because the currency is same, by the way. But I would prefer that even take it from the same country. Don't mix up the European stocks, because the exchanges are still different. Unless you want to see from the central, this main, this Euronext. You need to invest in stocks, obviously. Amount and proportion you can decide, but as long as you can justify that why did you invest. For example, if I take 3 stocks, British stocks, GlaxoSmithKline, Royal Bank of Scotland, and BP. And if I put more weight on GlaxoSmithKline, then I can give a reasoning that because it's COVID-19 and these pharmaceutical companies are highly involved in inventing this new drug. So I had a feel that GlaxoSmithKline would be very active stock, because it's spending huge amount of money in. So maybe the one reason, so you create some justification that why you invest a certain proportion. And also, you can pick up your risk profile. Are you a risk lover? Are you risk averse, or you are risk neutral? How do you know that you're risk? Sometimes you don't know until you make the calculations. But you find some standard textbook and find out that what determines if you take Adobe, Apple, and Microsoft, and you claim to be risk averse, then this is not working. So you need to pick up the stocks which basically fits in the profile of a risk lover, a risk averse, and risk neutral. And as I said, practically, sometime when you are analyzing the companies, you don't even know which category you belong to until you make some calculations. Okay. For example, we were doing a lot of research here about Microsoft in the last 3, 4, 5 years, and surprisingly, we didn't find it in a typical risk lover type of risk profile. On the contrary, we found Apple into the risk lover profile company. So it could be possible that because the company's phases change, and they do not necessarily remain in a given brackets. So the brackets of riskiness can also evolve over time. The rule of thumb is that beta is a good measure of deciding if you are choosing what is the risk profile of the investors. As a rule of thumb, if the beta is more than 1, it shows that you are risk lover. If beta is about 0.75 to 1, but below 1 or below 1, then you are reckoned as risk neutral. But if your stock or your portfolio overall package, basically stock, is below 0.75, then you can be considered to be a risk averse investor. And this is something additional information you can. So basically, I want to know, when you imagine this question comes in the assignment/exam, then when you solve it, you should be answering these things before you start showing me the calculations. So I want to know who you are. Are you a risk lover? Are you a value-based or growth-based? So so these kind of things. You can take long positions. So we're not concerned, because it's not a very, it's not a game. It's not some fun game. So just take the long positions. And what you need to do is that if you choose to, you can take long positions in the stocks on 2 dates. You can take the long position first on 10th of September 2020, which means exactly 2 years. Well, not exactly, but if it is 2 years. And the second position you need to take on 31st of January 21. So basically, the number point fifth, this fifth point is very important. You need to calculate risk and return from 2018 to 2020, and then carry it on to 31st of January 2021. So it means that you will be calculating risk and return, and also you will be splitting the return into, you will be breaking up the risk into systematic and unsystematic risk from 2018 to 2020, and then carry on from 2018 to 31st of January 21. And then find out that whether what is the situation, return, risk. So your first column would be return, risk on 2 periods. So if I take what is called column, first column return, second column total risk, third column total systematic risk, fourth column total unsystematic risk. And then the first row, not the first row, but the row could be first period. The first period is between 10th of September 2018 to 10th of September 2020. And the next row could be second period, which is 10th of September 2018 to 31st of January 21. And what happens in between? What happens in between? Is it so that your return has increased in these 2 periods, but the risk has increased disproportionately more? Or it could be possible that the risk has increased more, but the unsystematic risk has decreased over time. So these kind of analysis or this type of observation you need to do for this task. Okay. This is something I expect you to do. If you want, I can share if you give me 2 minutes, I can share one template spreadsheet with you. So far, based on the discussion we had today, I need to share 2 spreadsheets with you. The first spreadsheet, which I showed you about the, what was that? Just a sec. This was your efficient frontier. Yeah, efficient frontier. And the second spreadsheet will be based on this task 3, which I showed you. Okay. So if I just disappear for 2 minutes, and then I will find out one template spreadsheet and I would share it with you. Okay. So I take a very quick 2-3 minutes break now. Okay, so I can explain you a little bit about this third task. So what I did in this third task is that I downloaded the data of Finnair. You can see hopefully from the, can you see the spreadsheet actually? Because I'm not sure if you can. Yeah, so here, I took the last 20 years data for Finnair, about 2000, 4th of February 2000 till 31st, So we had the bid rate, ask rate. I will not go into that. So I took the closing price and some other things which I think that they come by default. So I took the closing price, and based on the closing price, I calculated the return, the daily return of Finnair. And then I took, for the whole of the period. And after I have the return of Finnair for this 20 years, I took it the average, because usually there are 250 working days in the stock market. And if you have 20 years, so it's about 5,000. And you can see that the highest is, the maximum number is L5037. So approximately 250 working days in the last 20 years in Helsinki Stock Exchange. And then I find out the average daily return. But this is the daily return. Usually when we want to show these statistics, we want to annualize them. So we can simply annualize it. Yeah, I think some people say that we should annualize to 365 days, but I think that it's not a good idea. Because normally we have 36 working days, so it's not a good idea. So I think we should annualize them for, 250 days, 252 days. So here I annualize it, and the average annual return of Finnair in the last 20 years has been 6.414%. And the same way, we can calculate the daily total risk, daily total risk of Finnair, but daily risk, okay? Mind it, that's very important. And then you need to annualize it. And once again, I think it's not a good idea to use 365. Some people say that we should use 365, but I don't believe it. And the risk is 33 points here. Yeah. And similarly, for the same period, I downloaded the OMXH Helsinki Stock Exchange Index. And for the same days, I took the closing price, like I took the data for the same days, same period, 20 years. For Finnair, I took for the index also. And then I could calculate the index return, like we did in case of Finnair. And then we have the average return, average daily return of the index. Here I have to sacrifice some of the observation because the data at the bottom was missing. You can do one thing, you can have the same minimum common data so that it's more similar. But yeah, and then you can analyze it. And once again, I would be won't be happy with 250. 365, not good. 252. And same way, we have the average daily risk of the market, and we can analyze it by 252 days, because I believe that 36 week is a good time for trading. And yeah. And after we have these statistics, so this is 9 point, why is it? Actually, I can just take like this. So this would be this. Sorry. So this would be actually this. And this would be actually and this would be this number. And this would be these are the ratios. And then after doing these calculations, we can find the, so I just found the ratio of, I found the ratio of return to risk thing that it has happened that for Finnair, the return for 1 point of risk, the return has been 0.19. Whereas for the overall market, the return has been 0.39 for the 1 unit of risk. So if you make a comparison of Finnair with the index, the FinAir has definitely underperformed in comparison to the overall market. And then we find the beta coefficient that we were discussing about. That beta is basically the slope. Even though the FinAir data was some 5,230 something, but I took the data range to 4645 because 4645 is the data availability of the index. So that's why I'm saying that when you have one row, 20 long period, well, you will only take 2 years, so don't worry too much. In case you find that the data of the closing price of the company and the index is not same, then of course you can't cook up the data, but at least take the basic minimum. So you can delete the surplus data of whichever column you have, but keep the minimum common data, cells. So the beta of FinAir has been 0.24, okay, which doesn't look very risky because it's kind of very low risk company if you look at the last 20 years. This is very low, I mean 0.24. And then based on this, you can calculate the total risk. The total risk of FinAir has been this. Okay, this is total risk as measured by the standard deviation. And then you have the beta. And if you multiply beta with the, what is this V13? This V13 is basically the is the risk, wait a sec, U16 is beta, and then you need to multiply with the standard deviation of the market, yes. So the formula of total systematic risk is, that you multiply, I hope you can see the comment here, multiply beta with the standard deviation of index. That will give you the total systematic risk in percentage. And now because you have the total systematic risk, you can find the total unsystematic risk. That is why we call total unsystematic risk as residual risk, because once you have total risk and total systematic risk, you can derive the total unsystematic risk likewise. Okay, so this is the task. There are other things also in this question, but I will not discuss today. We will carry on this spreadsheet when we meet next time, the next week. But the point I'm trying to make here is that if you look at the task 3 in the slides, you need to calculate FinAir, your portfolio return two periods from September 2018 to September 2020. So you'll be having two returns for the same portfolio. First for 2 years, September 2018 to September 2020, and then September 2013 to January end 2021. And again, you will have total risk on 2 occasions for 2 periods, which I just mentioned. And then you will be breaking up these risks into systematic and unsystematic risk in over 2 periods. And then you make this kind of, perhaps your your comparison table would look like this, that you have period 1, which would be, let's say, September 2018 to, 2018 to September 2020. And then your period 2 would be period 2 would be, starting period would be same, but the later one would be 21, and it'll be Jan 21. Because I want to see the incremental change. And then here you have the return. So X, and then you have total risk here. Let's call it Y and Y. And then you have the total systematic risk here. Let's call it Z and Z. And let's call it X1, X2, Y1, Y2, Z1, Z2, and then total on systematic risk. Systematic. Let's call it A1. And here you need to make some kind of change or observation. How does, when you compare this and this, compare this and this, this and this, this and this, and here you make some changes and comparisons. So this is how your final, when you are making interpretation and inference, this is how it will finally look like when you have done all the calculations. So make sure that I will not be, I would be very keen to see your calculations, and I would like to see the correct calculations, but the assessment will not be based on just calculations unless you make interpretation and inference. And I repeat, the way I understand interpretation is that, are you able to speak about the numbers in sentence form? Are you able to write it? And inferences is that, what are the implications, how it will have an impact for the company in the future, and thus it gives food for thought to the top leadership that what should you do that the bad thing doesn't occur in the first place. Okay, so yeah, so this is for today, everything. And yeah, and once I get this recording, I will be sharing with you, and we'll be meeting up next week as usual. Thank you so much. But if you have any questions before you leave, please feel free to ask. If not, then we'll be seeing each other next week.
Will you share this spreadsheet on Moodle?
I will, definitely.
Yeah, okay.
Yeah, I'll be sharing 2 spreadsheets today. Okay. All right, then see you next week.